As an investor, I'm always on the lookout for tools that can truly transform the way that we work as a business. AlphaSense has completely transformed the research process with cutting-edge AI technology and a vast collection of top-tier, reliable business content. Since I started using it, it's been a game changer for my market research. I now rely on AlphaSense daily to uncover insights and make smarter decisions. With the recent acquisition of Tegas, AlphaSense continues to be a best-in-class research platform, delivering even more powerful tools to help users make informed decisions faster. What truly sets AlphaSense apart is its cutting-edge AI. Imagine completing your research 5 to 10 times faster with search that delivers the most relevant results, helping you make high-conviction decisions with confidence. AlphaSense provides access to over 300 million premium documents, including company filings, earnings reports, press releases, and more from public and private companies. You can even upload and manage your own proprietary documents for seamless integration. With over 10,000 premium content sources and top broker research from firms like Goldman Sachs and Morgan Stanley, AlphaSense gives you the tools to make high-conviction decisions with confidence. Here's the best part. Listeners can get a free trial now. Just head to alpha-sense.com/invest and experience firsthand how AlphaSense and Tegas help you make smarter decisions faster. Trust me, once you try it, you'll see why it is an essential tool for market research.
The entire idea of business breakdowns is to focus on businesses, how they operate, and when they have the opportunity to invest in something that will return significant results, they should do it. On a personal level, you should be thinking about this as well. And it's hard to find something more important than sleep. 8 Sleep has legitimately been a game changer for me. I've lived for decades just saying I was a bad sleeper. But what I quickly learned is that I've been living a lie. The 8 Sleep Pod has climate control capabilities, and it's hard to emphasize just how impactful they are for getting deep sleep. You can go as low as 20 degrees below room temperature to knock you out, and then it gradually adjusts during your sleep to enhance the REM cycle, the deep sleep cycles, all that scientific stuff, which is, I can tell you, insanely important and wakes you up insanely refreshed. It fits right over your existing mattress, so it's very easy to install. And you have 2 separate climate controls, so my wife doesn't have to turn into an icicle form of Walt Disney while I'm cooling off on the other side. You may have heard of 8 Sleep from Friends. A couple guys I know, Elon, Zuckerberg, they're rumored to be 8 Sleep users. The hype is real. You can head to 8sleep.com/breakdowns and use code breakdowns to get $350 off a Pod 4 Ultra, which is what I've been using. The pod currently ships to the United States, Canada, United Kingdom, Europe, and Australia, and you will thank me later.
This is Business Breakdowns. Business Breakdowns is a series of conversations with investors and operators diving deep into a single business. For each business, we explore its history, its business model, its competitive advantages, and what makes it tick. We believe every business has lessons and secrets that investors and operators can learn from, and we are here to bring them to you. To find more episodes of Breakdowns, check out joincolossus.com.
All opinions expressed by hosts and podcast guests are solely their own opinions. Hosts, podcast guests, their employers, or affiliates may maintain positions in the securities discussed in this podcast. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.
Welcome back to Business Breakdowns. This is Matt Russell, and my guest today is Fernando De Leon, founder of Leon Capital. When I first came across Fernando and his business, I was interested to see what felt like a mix of a private equity portfolio, a family office, and a diversified conglomerate. And the more I dug in, the more interested I was. Fernando operates 14 different businesses under the Leon Capital umbrella, and they vary across real estate, healthcare, and financial services. But as you will hear in our conversation, the businesses are connected and instruct one another. I'd say there's an underlying theme or connective tissue throughout this conversation, and it's how demographic insight sits underneath everything. It's the foundation, to me, of what makes this business possible. And as you will hear, there's no better person to talk about demographic dynamics than Fernando. So please enjoy this breakdown that is part thematic, part insight into a modern-day operation. All right, Fernando, very excited to have you here to talk today. You have built a fascinating business. And when we were discussing where we could go with this conversation, there were truly no ends in sight in terms of how many different topics we could talk about. But one of the main things that I want to get into is your interesting perspective on demographics, real estate, how that's fueled a lot of what you've done. And I thought a good place to start is just with your story. I was hearing some of the anecdotes about it, going to school in 2 different countries in the same day, some of these fascinating dynamics. So maybe you could just sketch out your path to where you are today, and in the thumbnail version, however you think is best to share it. But I think that background is going to be really helpful to shape the conversation.
Sure. First of all, thank you for having me. I'm expecting this to be a lot of fun, and I appreciate you inviting me on the show. I was pretty lucky in that I was born in a very interesting part of the world. I was born alongside this southern Texas and northern Mexico border. And so I got to straddle 2 different countries on a daily basis. I got to go back and forth between Mexico and the United States, went to school in the morning in Texas and went to school in the evening in Mexico. And when you do that reflexively, you learn how to contrast people and systems. And so I've taken a lot of those lessons as almost like a social systems engineer, a person that is able to contrast what happens in either the United States or other countries. And I learned to have a real appreciation for things that are very productive in the United States. And that was a daily thing. I got my education on demographics, on social structure, on hierarchy, on economics. I got my education at a very realistic, pragmatic level by straddling that border. And that border happens to be an incredibly interesting one, even historically. Texas was a republic in 1846. The border of Texas has changed multiple times. It was its own country. It was part of the United States. It was part of Mexico. Before Mexico was a country, it was part of the new Spain. And so as these borders change, I think you get a lot of very interesting things happening between the borders that the United States shares that are unlike the borders that you would see in parts of Europe or Asia. There's not that much economic discrepancy to speak of. I think probably the only border that has more economic discrepancy than the United States and Mexico is probably North Korea and South Korea. And so the system where I grew up contrasted a lot, and it gave me a lot of lessons about how things could be made to be more productive. And so I think of myself a little bit in my career as a person that has designed organizations and businesses with those lessons in mind.
Yeah, your point on systems definitely rings true just in terms of how you've been building things. And one of the things that we talked about last week, which I thought you framed very well, and I wouldn't dare try to frame it again myself, is the importance of demographics to real estate. So could you sketch that out a bit just in terms of your thought process and viewing real estate through the idea and theme of demographics?
Yeah. So real estate is a broad asset class. In real estate, you have digital, which is telecommunications, equipment, data centers, cell towers, assets like that are all generating revenue. You have office buildings, shopping centers, what we call net lease retail, which has restaurants and banks and pharmacies. You have warehousing and logistics. You have housing, rental housing, and for sale housing. And so those are primarily the real estate asset classes that govern our self-storage and a few others that govern the real estate industry. And all of those subsets, all of them are effectively spaces that human beings need to conduct whatever life activity that they want to conduct. It's either where they live, where they work, where they shop, or it's the data center where they upload their photos, or the self-storage facility where they put some of their valuables, and so on and so forth. So every space that is developed in real estate has a purpose, and the people that use those spaces constitute a market that is all about the demographics of that consumer base. So if you think about in the rental housing business, we have renters that typically are 24 to 35, 37 years of age. They have disposable income. They usually spend 25 or 30% of their income on housing. And then they allocate their budgets, their disposable income based on their preferences. But we understand how they consume everything. For instance, I'll give you an example. We were really befuddled by the fact that we saw the budgets of renters change from housing. Their housing cost is the biggest part of their budget. Then car payments, school loans, you have food, but their second biggest payment cost was technology. That's not that surprising. So Netflix accounts and cloud services, everything that people pay for. But inside the technology spend, one of their biggest sub line items was gaming. And we saw that the gaming business was going to get a big part of the wallet share of our renter base. And so we see these trends in real time because we understand them as our customers in the housing business. And so many times when we have moved to make investments outside of real estate, we learned how to underwrite credit from the demographics of our tenants. So for instance, when we got into the dental business, we entered the dental business because we had a shopping center. We learned about the dental office. We learned their P&L. We learned that they were generating about $2 million in revenue in that location. They had about a 30% margin. So we said, oh, well, why don't we build the second one and support this business? So we did the second one, third one, and then that business eventually, we used our real estate capabilities to build a 300 location dental business, but we underwrote the credit of the tenant in the shopping center. So everything we've learned in business, we've learned it through the ownership of real estate, whether it's households or individual renters, or it's tenants in our shopping centers or tenants in our warehouses. We learn the demographics. For instance, the warehouse, when we develop warehouses, we develop them close to the rooftops because people want delivery of their goods. It used to be that the expectation for all of us was a 3 or 4 or 5 day turnaround for the delivery of a product. Now the expectation is you want it the same day. And that means that the warehouses that we develop have to be much closer to the rooftops that order these goods. And so all of these things are about human beings consuming things, buying things, living somewhere, how they spend their money. And so we learned through the real estate business about everything that relates to the American consumer that way.
I think you have 14 different businesses now that essentially feel like they're offshoots. They're very much tied into real estate, but they have some complementary pieces to them that can be associated with real estate, like you just described. I'm curious, when you go back to the idea of the systems thinking, has it been the case that you can take that model of the dental practice and apply that generally elsewhere nationally? Is it something where there's limitations to certain regions? I know you have global businesses. So just thinking about that, where the system either works incredibly well and where it starts to break down when you think about those various borders I just discussed.
First of all, our businesses mainly are encapsulated in 3 verticals. We own 3 businesses in real estate where we build warehouses, housing, and healthcare real estate. We own 3 businesses in the financial services sector, so insurance, financing premiums, and medical device leasing and consumer lending. And then we own 6 operating companies in healthcare that provide services in ophthalmology, dental, cardiology, mental health, etc. So those businesses, I think about them as complementary in some sense, but also, most importantly, we consider them essential services, essential needs, whether it's housing or healthcare. These are things that Americans really want and need. And we have about 6 million Americans that consume our goods and our services. And so I think about them that way. Yes, I think many of them, when we've entered them, we start by understanding what's happening in that business, what's happening in that industry. Where are there imperfections? Where are there productivity gains? Where can we do something different than the status quo or the state of the art, and where we can improve it according to our advantages? We have some advantages that others don't. Like, for instance, if we wanted to grow a dental business, we would say, hey, let's leverage our real estate teams to find those locations that we think have the best demographics. And so in pediatric dental care, we find that those locations are in suburban locations that have household formation. We like places in Nashville, in Dallas, in Austin, in Tampa, in Denver that are receiving a lot of immigration, a lot of household formations where families are relocating from other coastal markets, and we can go build dental clinics where there is strong household formation. We know there's families there, so pediatric dental care can benefit from those demographic tailwinds. And so we can leverage our real estate teams, build a clinic, a facility, build a brick and mortar. We don't think that Amazon is going to disrupt dental care because we think that it's hard for an algorithm to put braces on a young man or woman. And therefore, we think some of these businesses are less disruptible by technology. So we need those physical spaces. And so we can leverage our real estate teams and continue to grow that dental business. And there's quite a bit of synergy there. And then we can work on things like insurance for our properties and so on and so forth. Or the medical device leasing business may lease a medical device to that dental clinic. And so that's how we think about these ecosystems. We think about them as systems. And that logic sometimes applies better than others. But yeah, we tend to understand what's happening in those industries and find these openings where we can develop value for people, for customers, for human beings that can benefit from our services. And then if they like what we deliver to them, then they'll reward us.
Yeah, very much mini growing economies in their own ways and building the ecosystem for them. On your point of managing these different businesses, there's clearly synergies just in terms of information and visibility. When you think about underwriting as a conglomerate, there's always the question of where do the benefits come in? It sounds like these are operated as separate businesses. But I'm just curious on that point, are there ways that you can shift your underwriting strategy to view it as a mix of these multiple businesses and the net result is going to be better, even if it's at the expense of one in the short term? Do you change your approach at all when you think about underwriting?
Let me back up a little bit. So I started this business with very little resources. I didn't have a lot of capital. So every time I started a business or my initial business, I was operating with very finite resources, like all entrepreneurs do when they're getting started. And that scarcity of resources makes you very efficient. And I think we have always maintained that DNA of we have finite resources. We have to use them wisely. We have a couple of rules. We say there is no such thing as a small cost. The indiscipline of having an unnecessary cost means that it undermines everything that we do. There is no such thing as a small piece of revenue because small revenues can turn into larger companies. Every single large company in America came from a small piece of revenue and it emerged and evolved into a large piece of revenue. So I tell you that because my mentality has always been, I need to protect my downside when I start something new. I'll give you a couple examples. When we started in the veterinary business, I said, well, the demographics of urban areas have this skyrocketing pet ownership. But urban areas are very difficult to find real estate locations. And our team went into these urban areas and found difficult to develop real estate. And then we made that into a vet clinic, which resulted in great operating gains for the practice. But when we developed the real estate, we made a profit on that real estate. And then we used that profit to open a new store with the profits from the real estate. So we could sort of predict that if we built a clinic for $100, that we could sell that real estate for $130 and then use that $30 of gain to open up the actual operating location in that real estate or in another location. So we had some downside protection. And that's how we built all of our businesses, with a little bit of downside protection, maybe some propco profits that we reinvested into the gains of an operating business. And frankly, all of the people that I've always admired in business have used some version of that to protect their downside and to go and pursue some kind of research and development gain. If you look at Amazon Web Services, or who started doing it for their own account and then grew into a massive business, or LVMH that developed propco-opco strategies when their first investment in Dior and things like that, there was always a downside protection from an ancillary business where you could be bold enough and have that audacity to go explore a new business line. And that's how I've tried to do that. Same thing in insurance. I was tired of paying huge premiums. And I said, we need to start building an insurance business to protect the value of our real estate because those premiums keep escalating and growing. And our real estate always buys in property and casualty insurance. And so little by little, we went into that business. And we also, to your question on systems, we understood that the insurance system had a supply chain where there were intermediaries that made the cost of the policy more expensive. So as you had insurance brokerage and insurance reinsurance, all of those incremental costs made it more expensive. And I could build a business that didn't need a broker to sell me insurance. I could remove some of that cost because I was my own customer. And so things like that we understood about fleshing out a system and dissecting it and deconstructing that system to understand where value was. And then we could merge it with something we were already doing so we can build a self-sufficient company that also benefited something else we were already doing.
Yeah, it's an interesting framing of reinvestment opportunities. Anything that needs scaling, you require the profit from the actual asset, and then the reinvestment opportunity that's attractive ROI. Particularly interesting here when you have those examples of the vet clinics and the real estate itself and how that can trickle on. You mentioned some of those markets, and it feels like there's a real secular story behind what's happening there. I'm curious, is that primarily your focus, these regions which might be changing and have a lot of opportunity, basically as you go through the list of businesses that you've built out? I tend to think of real estate as this historically cyclical thing that the cycles may be various periods long in terms of years, but I'm just wondering, do you differentiate between the two?
Yeah, look, I think there are certainly cyclical elements of real estate, although those have changed significantly over the years as the pool of capital has broadened to support real estate development. So one of the things that we've seen over the last 20 years is that large pools of capital, whether they're insurance companies, asset managers, wealth management firms, RIAs, private equity, asset managers, pension funds, corporate and public pension funds have all allocated more and more dollars to a real estate asset class. And so as that has become institutionalized, you have this underlying support of capital that supports values in certain segments. Some are more institutional than others. I would say digital infrastructure, housing, and logistics are the primary beneficiaries of that capital support. And as all of that capital has come into the real estate industry, the cyclicality of those valuations has been diminished somewhat. The other consequence of the cyclicality of real estate and the incorporation of new capital sources into those industries and asset classes, what has also happened is that it's made it more competitive, where you have a lot of buyers that are insurance companies and asset managers and all of those pools of capital, and they are buyers of the assets from manufacturers like us. In that supply chain, we are manufacturers of housing. We develop that housing, and then ultimately that housing is acquired by a large pool of capital, eventually acquired by the large asset managers or insurance companies or pension fund separate accounts with an asset manager. But our job is to do all of that groundwork, to buy a piece of land, to entitle it, to get zoning permits, and to do all of that work, and then ultimately to design that housing in that jurisdiction, and then develop it, build it, understand all of the supply chain of construction. And then ultimately, once we've done building it, we have to lease it and then manage it and then cash flow it. And then that asset, eventually, we own some for the long haul, but most of the time they are acquired by large institutional investors who own large portfolios of these kinds of assets. And what we do is pretty difficult. In housing, for instance, every jurisdiction is different. So if we build in Dallas or in Tampa or in Phoenix, every small town, remember, a city like Phoenix could have 5 different suburbs, or a city like Dallas could have 20 different suburbs, and every one of them has different jurisdictions and building codes, has different laws that govern how to build housing. And so if Tesla's trying to build a car in a factory, they have a contained environment. This is where we make the chassis. This is where we make the IP. This is where we make the glass. This is where we assemble it. And they're all contained environments that you can replicate over and over. But the housing business does not allow us to do that. Every new place where we build has different topography, different building codes, different city restrictions. And so that makes it very hard to manufacture housing at scale. And we're one of the few that are private developers and manufacturers of housing that do it at scale every year. We build 3,000 units of housing, almost $1 billion of housing every year that we develop. And it takes a while to do that. Every project has a 3 or 4 year life cycle, and it's very difficult to do at scale. So we've perfected those systems to build that housing at scale. And we do that understanding that there are markets that have much higher growth potential than others. So we look at markets in the Sun Belt primarily. So places like Raleigh, North Carolina, or Austin, or Denver. If you'd like, we can go into why we pick those markets, but I think it's fascinating what's happening in those cities from a demographic standpoint.
Yeah, maybe you can elaborate. What would the characteristics be that you look for, and maybe what's happening there that drives that?
Those cities have primarily 4 ingredients. One is that they are business-friendly states where companies have been setting up their operations. So you go to a place like Phoenix, you have, in terms of digital infrastructure, TSMC is building a giant facility in the Northern Valley of Phoenix where they're creating thousands of jobs. And so evidently we're going to develop housing nearby. But you have a nearshoring of companies like TSMC that are building chip plants in the Northern Valley of Phoenix. You have the same happening in Austin, where Taylor, Samsung has done the same, build a giant facility there. You have biotechnology companies in Raleigh that have changed dramatically the demographics of a place like Raleigh, North Carolina, where it used to be the main industries in a place like North Carolina were tobacco and furniture and old school industries like that are no longer. Now you have a vibrant biotechnology industry in the Research Triangle in Raleigh. And that's primarily because you have universities like Duke, Wake Forest, UNC Chapel Hill. You have this giant educational ecosystem that is developing engineers and talent that when they graduate from those colleges, they go straight into these businesses. So you have a re-engineering of the base of industry in markets like that presents a great opportunity for us to develop housing. And when we develop housing there, we're making a decision on that household formation, that business-friendly climate. We're looking at cost of living that is attainable, families coming there. Well, what are we going to build if we build housing? Well, we're probably going to build a dental clinic. And if we build a dental clinic, then those families are probably going to order things on Amazon. So we should build logistics centers that will be leased to e-commerce companies and to the vaccine manufacturers in Raleigh that need storage space and things like that. So all of these are very complex systems that we tend to develop our business models around, and they're pretty complementary to places that are seeing job growth like Denver, Austin, Phoenix, Tampa, Raleigh, and Nashville. These markets are the new generational demographic places that are receiving influx of young people. Part of it is cost of living. Young people and households that have seen a cost of living lack of attainability in some of the coastal markets primarily.
And do you think when you described the challenges of every region or even every city has its own zoning dynamics, which make operating at scale challenging? The synergies are there to a certain extent, but you hit a certain point where it has to be customized. So that makes each in particular city need to be big enough on its own. How big is that opportunity set when you think about whether it's the US, and I don't even know if you would potentially do this abroad, but how many cities or regions or areas do you think exist out there where you could break into? And is there just enough runway existing in those markets that you mentioned to make it valuable focusing on that?
There are probably 12 cities that we would concentrate the bulk of our real estate development activities and our healthcare activities. But there are plenty of markets where we find opportunity that are not within those main cities. Oftentimes, let's say that we have an agreement with a large e-commerce company to build a warehouse in Indianapolis or in a semi-rural part of West Texas to fulfill the energy industry. I don't mean to imply that those are the only cities that we would bet on, because this is a giant economy. Those are our preferred cities, but our businesses have participation and investment in so many secondary markets, places like Savannah, Georgia. There are plenty of rural areas where we build healthcare facilities because we think that they're underserved. And so sometimes you could go to a place like Dallas and want to develop healthcare, and it's very healthcare clinics, and they could be completely saturated because they have so much population already. And so you're better off going to a rural part of Georgia and providing healthcare services there, or developing logistics and distribution in some of those secondary markets that have not been already saturated. So I think we have to take into account some of those supply and demand dynamics to picking our markets. But I mean, it's a giant economy. We have a $30 trillion GDP economy. There's no shortage of places where we can build both real estate, operating companies, growth, and then any of the other services businesses in lending or in insurance where we can do them anywhere, really.
Yeah, there's always opportunity somewhere. I did appreciate the precision in terms of the number, even though I appreciate that there's secondary markets as well, and some of those can evolve into those primary markets. One of the things that you mentioned before was nearshoring, and it was in the context of things happening in the U.S. with chip manufacturing. I think you can look at North America broadly and think about nearshoring trends. About a decade ago, there was a lot of discussion about bringing more of the auto plants either into Mexico or elsewhere. Just in general, as you think about the trend of nearshoring, the opportunity, the reality, how would you frame it, both from a U.S. standpoint, but then also from a Mexico standpoint as well?
Sure. Look, I think we went through a period of globalization where the Chinese economy grew from over the last 40 years into the second largest economy in the world. And we have been organized in the Western capitalist system across Europe, the United States, Latin America to be reliant on this globalized economic and trade system. And over the last, certainly since the pandemic, but even slightly before the pandemic, we have seen a decoupling need. What we all saw during the pandemic was supply chains that were disrupted, shipping that was disrupted, and we couldn't get basic things, whether they were respirators or equipment for hospitals or medications or ingredients to make medications. We were reliant on a globalized economic trade system that was slow, and we have begun a decoupling of sorts to do that. Some of it is geopolitical in nature. So you have an over-reliance on China for massive imports. And I think we have said politically that we would rather bring chip production, for instance, at TSMC or Samsung to the United States, to nearshore that or to reshore that in the United States. We also wanted to create jobs. So I think there was a political imperative to create manufacturing jobs in the United States. So that is also part of our objective as a country. And so what we've seen is these demands for space when we build logistics centers and manufacturing facilities in the United States. Some of it is the effect of those geopolitical elements that we all know too well in Ukraine and the Taiwan risk and so on, and the Middle East as well. So we have reshored, nearshored some of those supply chains to be less reliant globally. Secondly, I think we also have begun to develop space for food production. For instance, we see the cold storage business where the demand for that supply chain used to be reliant on agricultural producers in other parts of Latin America, et cetera. And so now the cold storage supply chain has become this almost like a security need for us to be able to protect our food in our own homegrown logistics chain in the United States. So we see a lot of growth also in the food and cold storage distribution chain. Certainly e-commerce has reshored a lot of facility and inventory to the United States. So to give you an example, China today, about almost 30% of all retail sales are done online. And all retail sales meaning everything we buy in terms of hard goods. In the United States, we're roughly at about 13 or 14% of all retail sales are done online. So if we catch up to China, that extra 17% of e-commerce infrastructure is a whole lot of distribution facilities and logistics enablers. And so that's going to be a massive reshoring operation for us to become more reliant on our own centers for distribution and supply chains, and to essentially hold more inventory stateside in the event of geopolitical disruptions. So those are some of the things we see. Mexico is the closest place to the United States geographically, where it has a great deal of labor advantages and cost advantages. We've already seen a great move. You mentioned the automotive industry. Automotive industry has been in Mexico for 3 or 4 decades. And importantly, it has developed the engineering talent and the supply chain of human capital in order to be able to manage facilities. Volkswagen, for instance, has its most productive auto manufacturing plant in the world is based in Mexico. They've become very productive. It's a young population, so there's a sufficient labor to man these plants. And also, labor costs. China is now 3 times more expensive on a labor cost than Mexico. And so you have serious advantages for the country to be able to develop a manufacturing base and to have some of those manufacturing plants reside in Mexico. So I think it'll be a more balanced combination of some manufacturing being near our shores in Mexico and some of that being reshored to the United States. And some of those are political imperatives, geopolitical imperatives, a gradual economic and globalized decoupling of our trade systems.
And when you think about that from an investment perspective, does the more free markets, the labor cost in China skyrocketing, the Mexico now being much more economically viable, even economically advantaged, that being one opportunity set versus the more politically driven, perhaps, with some things like chip manufacturing driving the case in the US. When you look at those two things, do you view them differently in terms of the opportunity? Is one more attractive than the other?
When I think about the allocation of my capital in the holding company, when I think about that capital allocation question, I can simplify it this way. If you invested in China, I don't feel like you actually have a rule of law that protects your property rights the way the United States does. So that has a severe disadvantage to the United States. When I think about the political systems in Latin America, they tend to be more volatile, and you have to account for that in your risk and return adjustment. So you have to get paid for that risk. When I think about Western Europe, I think about demographics that are growing at a very low rate relative to the United States growth. When I think about any other country, the vibrancy of their capital flow and their capital supply, I just don't see anything where the value of your assets is as protected through a rule of law, through a robust capital system that can value your assets in either a public or a private setting, and property rights that are protected through a stable system of governance in this country. So between growth, rule of law, and the robustness of the capital system that values your asset, it's not even a close call. This is the greatest place in the world to invest. And then when I peel back another layer and I say, well, where in the United States would I invest? I find that those cities that have great household formation that I mentioned, like Dallas and Austin and Phoenix and Denver and Tampa and Raleigh, I'm in love with those places because of their household formation and the robustness of their economic growth for the foreseeable future. So not even a close call, Matt, on how we think about capital allocation.
I appreciate the reframing of that. It was ultimately where I was getting to. It was effectively done. On the point on logistics hubs and the e-commerce sales, we've seen this big shift. Where do you think we are just in terms of the brick and mortar, the retail footprint in terms of real estate, which obviously we've seen a lot of change with malls and everything that's happened. But if you were to think about the opportunity set there, is it still this secular shift away? Are there opportunities that you see on the retail side, or is the industrial opportunity significantly more interesting at this point?
Yeah. First of all, what we saw several years ago, was that there was a displacement. Take an example of Bed Bath & Beyond. They have a lot of hard goods. They have Tupperware. They have towels. They have all sorts of things that they're selling. And you used to go to that store and buy it. And now you can go online and you get it delivered. And it's a much easier experience. And the users and our consumers in the United States have spoken clearly that they prefer to do that. So it's no surprise that you see a lot less brick and mortar Bed Bath & Beyond stores and more online delivery. And so that has already happened. We saw that start to happen many years ago. Like I said, all retail sales today are about 13% of all retail sales are done through online sources or means. And so I don't expect that will stop. I think that goes from 13 to about where the Chinese are today. About 30% of their sales are done online. So even when you see what happened with the pandemic, I mean, you saw a lot of adoption of things like Instacart, and you saw an older population that wasn't necessarily going to be an Instacart customer. You saw 70-year-old consumers that decided to use Instacart to have their groceries delivered. And that may come now out of a cold storage facility, by the way, instead of from the Albertsons. And so that person was a 70-year-old consumer that maybe wasn't supposed to be technologically adapting to Instacart, but they did because they had to during the pandemic. We saw this massive acceleration of adoption of those kinds of technologies that changed the need for brick and mortar retail. Having said that, and almost ironically, because we haven't built any retail in a lot of years, there hasn't been a lot of new development of new space.
Supply, yeah.
Then it's all occupied. So we have this interesting phenomenon where a lot of the retail real estate in America is leased at over 95% today across the board. You still need space for Starbucks and Chipotle, and you need experiential space for Dave & Buster's and to go play video games or whatever people are doing that requires a brick and mortar location. There are still many places. There are places like Home Depot that cannot go online because what they sell is really bulky and it's hard to deliver. So if you've got equipment or tools or big pieces of wood and things like that, it's hard to deliver that through e-commerce. So some of that is still in brick and mortar for some retailers that will maintain their brick and mortar presence at a pretty stable level. So those are some of the dynamics at play in that field.
Yeah, it certainly seems like the supply base has corrected properly. So now you have an interesting, at least, reset there. On the storage hub logistics networks, it's very interesting where you have these businesses that needed to have a centralized hub or maybe a couple of regional hubs, but they're not necessarily designed for the next day delivery in the same way that Amazon has. And I'm curious if you see much movement there, where I think there was phase one of e-commerce where a lot of this was being done out of stores, which maybe aren't necessarily set up to make those deliveries. And what innings you feel like we might be at with the industrial opportunity, particularly on what supports the retail sales operations and anything that would be related to e-commerce?
Yeah, so there's been massive evolution in the logistics centers, mostly through the automation of their equipment inside of the facility. So sorting facilities, the equipment, the automation, the robotics. We have a tenant that was telling me that they have about $3.5 million of automation equipment to move furniture around. That's a 300,000 square foot facility with $3.5 million of robotics and automated equipment that allows them to move furniture out of their facility for delivery. And so you're seeing massive innovation in that infrastructure. Certainly, Amazon and the large players have been way ahead of the game in the development of that infrastructure. But even smaller, medium-sized companies are spending a lot of money to build out their equipment, their automation. Interestingly, we realized that some of this automation equipment and sorting and robotics in some of these facilities, that it was hard to underwrite the warranty risk. And so our insurance company is currently looking at that business, at insuring warranties for equipment like that, because a lot of it was new and the actuarial tables for the useful life of equipment like that was hard to evaluate. So there were some inefficiencies in that warranty and insurance market that we've started to look into. But the point is, as we evolve to more online consumption, we are seeing massive innovation in automation, in robotics, in the management of SKUs, and the facilities that we build that are much more modern today. Not surprisingly, our warehouses that we build, they used to be 28 or 30 foot in clear height. So the ceiling height was 28 feet or 30. 20 years ago, maybe it was 20 feet. Today, we're going all the way to 40 or 42 feet high, because that way there's more volume that you can store for delivery in those warehouses. So those are some of the few innovations that are happening in the development of that modern distribution space. And they're happening real time. And there's a lot of innovators that are building. It's interesting to see the robotics and the software that goes into moving goods around and putting them on trucks and then delivering those goods to us. The software, the robotics has grown and been innovated 800% over the last 4 years, I would say. I mean, it's a massive overhaul of how these sorting and distribution facilities have become much more efficient.
I'm just curious, is it mostly on the tenant in that case to invest in the upgrades? Is the owner of the real estate ever making those investments? I imagine it'd be hard just given the customization for each tenant, but
we have a term in real estate that we call build to suit. And so sometimes we build to suit a tenant. And in that type of transaction, they ask us for spec levels. So specifications that require some level of upgrade or improvement. Some of it is infrastructure based. Sometimes it's power. Sometimes it's energy and power that we have to customize to that end user. Sometimes it is the spec level, and sometimes it is a little bit of technological infrastructure that has to go into the building. So it all depends on the contract that we have with our tenants. But I will tell you that on the question of power, it's been interesting, the struggle for finding power, developing logistics centers and manufacturing centers that we build, and to find adequate energy and power sources, especially in competition with data centers that are gobbling up data energy at an exponential rate.
From an investment opportunity perspective, is there something that you view as the natural gap filler there, whether it's the super clean sources, in nuclear obviously being in the press a lot more recently? Anything that you're seeing, whether it's just as an observer or from an investment opportunity perspective?
Yeah, on the energy source, I definitely think nuclear can fill the void. I think natural gas in places like Texas, we've seen wind and solar. I mean, a big part of the grid is now receiving energy from solar and renewables in Texas. So we've seen that. I haven't had the opportunity to see anything that is much more innovative than that, but we do see that the states where we are investing are providing incentives to solar and wind energy developers to provide that energy. And I think the mindset of any given place to allow that infrastructure from sprouting will have economic development related to it. And so the states, the friendlier they are with incentives to those developers to create renewable energy sources, the more you're going to attract increasingly in this fight for energy. You're going to attract new businesses for manufacturing or distribution or anything else. So I think, cities and states would be wise to be more public about their incentives to lure renewable energy producers to their state.
And on the data center point, just thinking about the investment opportunity there, whether there is one, it's been incredibly popular in the markets. How do you view it from your perspective, whether it's opportunity, too competitive, something else? Where would you bucket it?
I think in that business, it's very capital intensive. The numbers are very, very large. They're staggering. You need to be a very large asset manager or public company to be able to deploy capital at those levels. I think in that space, we are going to be more picks and shovels, and we're going to be selling into that market without having to compete on the development and ownership of them, because they're very sizable, capital intense investments that we're not likely to be competitive right now. And those markets are very efficient. So the rates of return are going to be almost like public utilities, I suspect. And so not something that is the right thing for us in this moment in time. But again, picks and shovels, something that we can sell into that market. Maybe it's land, maybe it's construction services, maybe it's taking land near power sources that we can approve for zoning and entitlement and then contribute it to the large data center owners that have a lower cost of capital. But there are sufficient places where we can play that trade.
We'll start to wind down here. This has been a fascinating, wide-ranging conversation. I think we've talked about a lot of different themes that you see, some of them secular, some of them maybe more cyclical. But as you approach it as a business, how quickly can you respond to some of these things? I'm sure it's a challenge, but it feels increasingly important, whether it's the automation and upgrading of logistics centers to the data center and figuring out the right opportunity there. How do you approach that in terms of timeline to actually allocate capital and do things?
The way I think about that, I've always said that our organization here at Leon Capital is a place where we can do a lot of research and development, do study and experiment with new ideas, a play yard for entrepreneurs that can come and develop new ideas. We've had great success doing that. When people come to us with something new that we want to understand or research or develop, we've incubated great businesses like Crexy, which is a technology business that I'm very proud of. Today has 4 million users that come to the site every month to get data and information for real estate. And we're a marketplace, we're a data provider, we're an auction house. And that's a business that we incubated here with a few people that had a great idea to build a real estate technology business. And we used all of our knowledge from real estate to support them, to build this amazing company that we're very proud of, that is very valuable, and that has this extraordinary place in the market. And so we constantly respond to these opportunity sets. And I think our only advantage is to be nimble and to be quick and to be flexible with our thinking. So can we go to first principles and break down an industry and have a better understanding of what's really happening in the value creation process so that we can position ourselves in a sweet spot to create value, to provide value, and then ultimately to extract value for our partners or entrepreneurs or the people that work with us. But I do think this is a place, it's a very fun environment where people are constantly debating ideas, and we can be very nimble about responding to things that come in the door pretty quickly. And it's generally a DNA here or a culture that is intellectually curious. We went into the mental health business because I was really curious about what was happening to cognitive health of Americans. There's things like that we can jump on really quickly. And if there's an economic thesis around it, there's an idea where we can position ourselves in the right part of the curve to create value, and we can do it better than others. I think generally speaking, we have a group of people here that get excited about things like that and are quick to jump on them. So I think it's a special place. Obviously, I'm a little biased.
Understandably so. And I'll close out just with a forward-looking question. And I think you've provided a lot of forward-thinking thoughts just in terms of where we are. But in 5 years, when you think about the opportunity set that you have, do you think that there's anything that will be dominating the conversation if we were to have the same one 5 years from now, which maybe didn't take up as much of the discussion or maybe wasn't even mentioned? When you think about the forward outlook, is there something that you would point to that will be increasingly important?
Yeah, so I think as our society becomes more complex, most of the things that we consume or that we need in services will have a larger technological footprint. So most of the delivery of services and goods will have a more impactful footprint from anything related to tech or tech enabled. And so we are already managing systems in AI and everything that impacts our ability to do what we do today through technology. So I suspect that if in the total delivery of what we do, out of 100%, 25 or 30% was technologically driven over the last 15 years. I would say that 65 or 75% of everything that we do and touch will come from a technological innovation or from a technological product that we are either investing in or incorporating into businesses to make them better and faster. So I suspect that our entire capital allocation will be much more reliant and skewed towards technology-related businesses and technology-related elements.
It's fascinating to hear how you've evolved the business as the economy evolves and very much alongside it and will continue to do so. Your lens into this world is very interesting. Thank you so much for sharing the knowledge, Fernando.
Absolutely, Matt. Thank you for having me. It's been a fun discussion.
To find more episodes of breakdowns ranging from Costco to Visa to Moderna, or to sign up for our weekly summary, check out joincolossus.com. That's JoinColossus.com.